Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Before we start, a thank you to the heroic first responders fighting the Southern California fires. Thank you, thank you, thank you. Tonight, I return to campus, where I am an adjunct professor at USC's Marshall School of Business. There, I teach two separate courses, one on fixed income and a new course on Bitcoin. Tonight, I resume my fixed income professorship at USC, and I'm very excited to be back on campus. As I was preparing for tonight's lecture, I put together some slides for my students today to explain to them what fixed income is all about and to give them perspective. Now, one of the things that I do always on my first day of lecture is I express to my students they must start thinking in trillions. Without the ability to think in trillions, we cannot physically comprehend the size of the financial system. So today's video is dedicated to thinking in trillions. We'll go through the fixed income markets, treasuries, the US economy, compare treasuries to other asset classes, and get a sense for just how large the financial system really is. Why does this matter for Bitcoin? Because Bitcoin responds to expansions in the financial system, notably the creation of new money by central banks and commercial banks. So today's video will go through the size of the banking system, compare it to Bitcoin, and explain why the banking system is guaranteed to continue expanding. Now, remembering that we are here today to think in trillions, we should understand that Bitcoin's market cap right now, the size of Bitcoin's total market capitalization is under $2 trillion right now, just about under $2 trillion. And with that, we can see really how small Bitcoin is compared to the rest of the financial system. All right, let's go to our first chart here, an overview of the US capital markets. Now, the green line is the sum of the NASDAQ and New York Stock Exchange stock markets. So basically, that green line represents the total sum of US stocks by market cap. Now, you can see here that the size of the US stock market is above $60 trillion, a number that viewers and listeners of the Bitcoin Layer might be more familiar with is the second number on this screen, 36 trillion, the orange line, $36 trillion of total US Treasury debt. So that is the size of the US government's debt load. That is how much Treasury securities exist in total. Now, 60 trillion compares to 36 trillion. This is a number that TBL viewers and listeners might be more familiar with. This is the total sum of Treasury debt. So the US government issues bonds, that money has to be paid back. So the total debt equals the total number of treasuries outstanding. And that right now is 36 trillion. So the size of the US stock market is not quite double, but in that range of almost double the size of the US Treasury market. The next number, 17 trillion, is the total number of deposits held at commercial banks by individuals and companies. So this is the domestic banking system and 17 trillion of deposits in that system. The next number in red, money market fund assets. So these are money market funds that are held by people and companies and investment managers. The money market funds themselves own deposits, treasury bills, which are within the blue and the orange line. No stocks are in those money market funds. Money market funds are not legally allowed to own stocks. They're also legally not allowed to own most of the treasury securities out there, only bills, so only securities that are 1 year and less in maturity. We'll show you a breakdown of bills versus the total treasuries outstanding later in this chart pack. But I wanted to show you here, compare money market funds to deposits, to treasuries, to stocks. And you can see here that stocks at 62 trillion really dwarf the size of the Treasury market. If we include all of US fixed income, the numbers between stocks and bond becomes a lot more similar. You have about 12 trillion in mortgage-backed securities. That gets it up to close to 50 trillion. And you have corporate bonds, gets it closer to 60 trillion. So the size of the US fixed income market and the size of the US stock market are similar to each other, around 60 trillion each. That puts the size of the US capital market well over $100 trillion. That is why you guys have to learn to think in trillions, because when we talk about a trillion here, a trillion there, or Bitcoin being 2 trillion in size, if you're not able to compare it to treasuries at 36 trillion or stocks at 62 trillion, how do you even have context? And that's why we must think in trillions here at TBL. As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TBL. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever, and the main culprit, the main reason, is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush-proof, and time-proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. Now let's go with that 36 trillion, because my class is about treasuries. That's my asset class. And when I say my asset class, that's my background, where I come from. I traded treasuries for several years for large institutional asset managers and institutional clients. And as a treasuries trader, you have to be able to really think in trillions, because every announcement that comes out of the Treasury or the Fed has a T in front of it. So let's take that 36 trillion number and give it some more context. What is the size of the US economy? So in blue here, you see that the size of the US economy is about $30 trillion. That puts debt to GDP at about 120% in red. Now you can see here that the red line spiked in 2020 and has come down a little bit ever since. So why did that happen? The spike in 2020 was due to two things. Number one, a fall in US GDP during the pandemic, as well as a spike in debt as the pandemic response was in the multi-trillions. So you had a divergence of debt and GDP, therefore a spike in the debt to GDP ratio. Since then, though, the ratio has come back a little bit. What is the cause of that? The cause of that is not falling debt, as debt has still risen and consistently rises. We actually don't see the total treasury debt ever fall. It's an occurrence that we haven't seen for about a decade, and we don't anticipate seeing any changes unless we get material changes to fiscal policy, but we'll keep the next administration's policies out of today's video. So We have a debt to GDP ratio that came down slightly from the pandemic. What is the reason? The reason is increasing GDP relative to the increase in debt. Now, how do we get increasing GDP, especially on a nominal basis? Inflation. So inflation has been one of the key ingredients to get debt to GDP lower, because if you have inflation, the same amount of economic activity is a higher nominal figure. That higher nominal figure has the ability to bring in higher nominal taxes, and that can shrink the debt to GDP ratio at the margins, and just all else being equal. Now, the United States is in a very precarious fiscal position. We'll discuss that a little bit later on in the video, but we must understand that a debt to GDP of 120% is restrictive. Restrictive meaning that the marginal tax dollar that is paid into the system is more and more going to interest only. It's not going to services. It's not going to the military. It's not going to retirement, Social Security and Medicare beneficiaries. It's going right to bondholders. And if the U.S. taxpayer is paying only the bondholder and not paying for any of the defense budget or the benefits to retirees, that is restrictive. That is a restrictive condition on the economy. So not a good thing, and we have another chart later in the chart pack to go deeper into that. Now let's give that 36 trillion one more number of context that really dwarfs it once again. So this is the orange line now, the total central bank and banking assets from around the world. This includes Fed, ECB, Bank of Japan, and the People's Bank of China, dollar adjusted. So 120 trillion, pretty much the same size as the US stock market plus the US fixed income market. We have another 120 trillion in terms of the total number of bank assets around the world. Now remember, banks can own fixed income. They can also own stocks. But the majority of banking assets are loans. So that's more corresponding to that deposit number that we saw earlier. So there are a lot of numbers in the trillions. A lot of them cross over with each other, meaning that some of the orange line is Fed and domestic banking assets. Some of those assets are Treasury, so the red line here. So some of the orange line is owning some of the red line. And that green line here is the Fed only. So we're pulling the Fed out of the orange line. That's Fed assets only. You can see the Fed owns about 6 trillion in securities. That's mostly treasuries and some mortgage-backed securities. So this is a way for us to put all these trillions together. 6 trillion in Fed assets, 36 trillion in treasury debt outstanding, 120 trillion in total banking assets, 60 trillion in US equity assets, 60 trillion in US fixed income assets. All of these large numbers help us understand how large the system really is. That way, when you hear that Bitcoin is at a 2 trillion market cap or Nvidia is at 3 trillion market cap, you have some context to these numbers. Also, when the government announces we are going to do a 1 trillion tax cut or we are going to do a fiscal stimulus of $2 trillion, you understand a little bit more what that number means relative to the size of the US economy. Now, zooming into that 6 trillion number, the total Fed assets, how has that changed over time? You have QE1 through 4 here on the screen, as well as QT1 and QT2. Right now, we are in QT2, the tightening of the Fed's balance sheet and a shrinking of the Fed's balance sheet on an absolute basis. Right now, the Fed is shrinking its balance sheet and still does not have any concrete plans to end that program. We are watching it closely, though, because we do see the usage of SOFR spiking. We see SOFR being the amount of securities that need to be financed through the repo market at the primary dealer level. If the Fed owns less treasuries, that means the primary dealers have to keep inventory for more treasuries. As they keep more inventory, they have to finance that inventory, and they do so in the repo market. Another factor causing us to believe the Fed will not be doing QT much longer are the quarter end and year end events that we've had within the repo market. We've seen interest rates spike around the calendar. That means there is a tightness of funding. If the Fed continues to not purchase treasuries, that will continue to keep conditions tight in the funding market, in the repo market. So we do expect the Fed to come back into the mix here soon, sometime this year. Again, why does that matter for Bitcoin? Bitcoin responds really well to an expansion in total banking assets. A special mention here for TBL Pro. If you are interested in learning much more about the way that the Fed, commercial banking assets, and interest rates in general affect Bitcoin and Bitcoin's price, consider becoming a TBL Pro at thebitcoinlayer.com. Part of TBL Pro's offering is our exclusive and proprietary index called TBL Liquidity. This is a model that we've built that has over a 70% correlation with the stock market and Bitcoin. So a really good indicator to give us a sense of what's going on in the banking system and how it impacts Bitcoin. Let's take a look at mortgage-backed securities here. So we have the total mortgage-backed securities in green, and the orange line at the bottom is the number of MBS held by the Fed. So that purple line is then the difference. That's the number of mortgage-backed securities not held by the Fed. Now, if we think about percentage of MBS held by the Fed in total, we see that number falling as the Fed has done more and more quantitative tightening. Now, at under 20%, the Fed is leaving the mortgage market more and more. We saw that number at 25% in 2022. So the Fed leaving the mortgage market puts an upward pressure on mortgage rates because there has to be private capital that comes in to fund that mortgage borrowing at the American household level. If rates continue to creep up in the nominal part of the curve, that means treasuries broadly, that will send mortgage yields higher. But mortgage yields also respond to the fundamental dynamic of how many mortgage-backed securities are owned by the Fed. So as the red line goes down, the pressure on mortgage spreads goes up, means more expensive financing conditions for home borrowers. Another reason why we don't think the Fed can do QT for long. Now, I will say here that the Fed has, for years, tried to exit the mortgage market entirely. There's even speculation that as inflation is stubbornly high, the Fed might sell mortgage-backed securities and replace that holding on its balance sheet with treasuries. We don't see that as a very likely and sustainable scenario because it might put a really restrictive condition on home borrowers, and that will work counter to the Fed's appearance in the public. The public wants to see the Fed doing things to help it, not hurt it. And so if mortgage rates continue to go up, that will be something that the Fed will be hearing from the public, Congress, and will want to respond to. So for us to think that the Fed is just going to gracefully exit the mortgage market is high hopes. I promised you we would talk about bills relative to Treasury. So you can see here now that the total Treasury number has fallen from 36 to 28 trillion here. That is because a lot of Treasury debt, we saw how much the Fed owns, about 6 trillion. A lot of that debt is held by interagencies, so the Fed and other agencies. That means there's about 28 trillion in marketable debt, 6 trillion in bills. That's about 22% of treasuries in bills outstanding. So that means that about 22% of all treasuries are T-bills. The more T-bills being issued, by the government puts a higher roll risk. That means the government has to fund itself more often. It has to go to the market to reborrow more often if it has more bills, right? Because bills mature within a year. So the higher percentage this goes, the more the Treasury has to borrow every week when maturities happen. And maturities happen every single week in Treasury bills. Historically, a government that keeps a lot of funding needs in the short end of the curve is going to be subject to conditions that it's a dangerous situation because funding can then disappear. If you haven't secured your funding for 10, 20, and 30 years, you run the risk of your lender saying no thank you the next time you go to the market. Now, there is an unlimited demand for Treasury bills as basically the best cash instrument in the broad financial market and capital market. So we're not necessarily worried about that from the US government. But the government is dealing with a very high interest rate bill, especially as yields continue to creep back up here in late 2024 and early 2025. One of our key themes at the Bitcoin layer is debt monetization by the Fed and increasingly by commercial banks. We are looking for 2025 and 2026 to be a large year of T-bill issuance, Treasury issuance, and a lot of that issuance to be mopped up by the banking system. Currently, it's only the commercial banks that can do that because the Fed is still shrinking its balance sheet. But let's see how long that can last. Our next chart here is a money markets monitor. So again, I'm trying to include a metric from the chart before so that you're piecing these numbers together and connecting one number in the trillions with another number in the trillions. So here we have two numbers on the screen that you've seen before: money market fund assets in black and Treasury bills in green. Those are both in the 6 trillion range. Now I've included a few more here. One in purple, this is the SOFR balance. So we were talking about dealers needing repo funding for all their inventory. That's SOFR. The orange line here is Bitcoin's market cap. You can see just under 2 trillion. And finally, reverse repo. This is a Fed facility that is basically winding down as the Fed no longer needs an additional place for people to put their money. Now, this next chart gets to what we were talking about in terms of interest payment for the government. The government is in a tough spot because it is spending so much of its tax revenue straight away on interest. And that is what we are seeing here. The red line let's start with the blue line. The blue line is how much interest the government is paying every year. So that's where you say AR in the key, that's the annual rate. So we're at about 1 trillion in outlays for the government every year on interest only. How much money does the government collect? The annual rate on tax receipts is 3 trillion. So if 1 trillion out of 3 trillion is going right to interest, that means that the taxpayer is paying not 3 trillion for services and military and to their grandparents via Social Security and Medicaid, but 1 trillion is going right to bondholders. This is not great for the US government, spending too much money on interest, especially with interest rates now approaching 5%. The percentage is 35%. And you can see, though, that is down from 50% where it was in the 80s. So the government was spending a lot more in terms of the percentage of tax revenue on interest 40 years ago than it is today. But it's spending much more than it was 20 years ago, because 20 years ago, we were at about 25 to 30%. Now we are approaching 40%. So this, again, helps give us context. 3 trillion in tax receipts, 30 trillion in GDP, 1 trillion in interest expense, 36 trillion in total debt. So that 36 trillion, you could just do a quick mental calculation, if you do 1 divided by 33, that's about a 3%. So if you had a 33 trillion in total debt and 1 trillion in interest, that means 1 out of 33 is your interest percentage. So about 3%, a 3% bill on your 33 trillion gives you a 1 trillion interest bill. And so that's how we think about rates where they are. Rates are at 4%. So if the average rate is around 3% of the existing debt and the new rate is in the 4.5%, that means every time a maturity hits, you now have more interest expense going forward for the next 12 months. And that's a bad thing for the US government. So we have to continue to watch that. The next one, again, 3 trillion in blue. I give you much more of a time series here. We go back to the 40s, and you can see what are the tax receipts as a percentage of GDP. Right now, it's 10%. It has been as high as 15% several decades ago. It was as low as 8% in 2010. So tax receipts relative to GDP, they're decent. They could go up if we had higher tax rates. But guess what? We're going to have lower tax rates going forward. If we can get higher growth, then we can get tax receipts to go up in terms of the percentage of GDP. That's how we can get debt to GDP down. So when we think about the government and how they have to operate fiscally, these are the numbers that we have to use. Now, our last chart is to go away from the theme of trillions and just quickly take a look at where central bank interest rates are around the world. We see that the orange line, which is the Fed funds rate, has stepped down 3 times but has pretty much flatlined now, as the expectation is for no more cuts this cycle. Essentially no more cuts. You have this gently downward sloping curve, but basically no more cuts priced in. In Europe, though, in green, more cuts. And that's why you see the dollar strengthening versus the euro on a pure interest rate parity, interest rate differentials move. US rates constant, Europe rates down, buy the dollar and sell the euro, looking for the higher rate. That strong dollar is the major theme for us at TBL right now. It has the potential to act as a restrictive condition on the global economy. It's also sending capital into cash. That is causing money to come out of the stock market. All of these dynamics are happening on the margin. We don't want to make a big trend out of lower stocks, especially as they come down to a support line. Make sure you guys are subscribed to TBL Pro. That's where we give you all of our best technical analysis levels in our mean median mode report. It's a quantitative risk report that really combines all of these metrics into one metric that we call TBL liquidity. So definitely go check out TBL Pro at thebitcoinlayer.com. Now, if you look at the blue line, Swiss National Bank also expected for more interest rate cuts. The BOE is expected to cut rates, and the UK government right now is in a mini sovereign debt crisis as its 30-year gilt yield spikes and is in unprecedented territory right now for the last several decades. A quick check of the chart shows us that the UK gilt yield is where it was in 1998, so a 26-year high in UK yields. Something to watch definitely for sure. And we are going to be watching how the Fed responds to an increase in growth and inflation expectations. The expectation is that they're not going to do much. This will strengthen the dollar and this will threaten the risk markets more broadly. That is the price action you've seen here over the last couple weeks. Bitcoin is bouncing down against this $90,000 area, something that we're really keeping our eye on. So another thing that we want to be watching closely, and we'll continue to do that at the Bitcoin layer. Thank you for sticking with us today, guys, and we hope that you are able to keep all these numbers above 1 trillion all the way up to 100 trillion and beyond in context for Bitcoin and Bitcoin's rise over the next several years. as it goes past the gold market cap, which is currently right now somewhere between 15 and 20 trillion dollars. Again, thanks for sticking with us, and we'll catch you guys next time.